Do you have at least $10,000 saved up for medical expenses? What if I told you there's a way that you can save that and also get a tax deduction? Today, we're going to talk about health savings accounts, HSAs, and how people use those to build tax free wealth, and why I recommend almost all of my clients get an HSA. My name's Anthony Brister. This is a wealth planning podcast. Today we're going to talk about HSAs, one of the most powerful savings accounts out there. You can use them for your health savings. You can use them to build tax-free wealth, grow and accumulate that. Before I get in, I want to say please like and subscribe below. If you have any questions, feel free to comment. So let's get into it. So what is an HSA? An HSA is a health savings account. And in order to qualify, you need to meet a few criteria. So first, you have to have a high deductible plan, also known as a HDHP. What that means, in 2024, your deductible, if you're single, it must be at least $1,600, and if you're married, it needs to be at least $3,200. You cannot have any other health coverage, and you can't be enrolled in Medicare. Typically, that's when you're over age 65. In 2024, the contribution limits are $4,150 if you're single, and $8,300 if you're married. And if you're over 55, you get to actually put in an extra $1,000 per year. So what does that mean? Well, that means that you get a tax deduction for the amount that you put into your health savings account. So if you're at a 20% bracket and you put in $8,000, if you're married, that means you're getting a $1,600 tax break on the federal level. That adds up over time. You contribute that each year. If you're married, you can have $16,000 saved up in this account over 2 years, which can cover a medical emergency, or you can invest it, continue to grow that thing over time. So it really can be impactful. So what are the benefits of an HSA? Well, everyone says they're triple tax advantage. So what does that mean? Well, first off, when you put money in, you get a tax deduction. Like I said, with $8,000 at a 20% bracket, you're getting a $1,600 tax deduction there. But also, you can put that money in there and invest it. That money grows tax-free throughout the time that you have it invested and you're using it. You can self-direct it, or you can put it in the market. But either way, as long as it's sitting in that account, it's not going to be taxed on its earnings. So just like a traditional IRA or Roth IRA, that money is sitting there growing, either tax-deferred or tax-free. And then lastly, that money can come out tax-free as long as it's used for qualified medical expenses. So kind of like a Roth IRA, when you take money out, as long as they're for the qualified medical expenses, you're going to not have to pay taxes. Now, if you wait till age 65, you can actually take that money out too, and you'll be taxed at ordinary income, kind of like a traditional IRA. Most people use it for medical expenses, but again, if you wait that time and you built up a substantial amount in that account, you can also take that money out like a traditional IRA. So really, really beneficial. They're also very flexible. So, you don't have to put in a set amount each year. You can put up to the limit, which I recommend doing. However, if 1 year you have a bad year, you don't have to put up to that amount. You can put up $100, whatever that amount is. Also, you can pay for an expense out of pocket and then come back several years later and get that reimbursement. What that benefits really is it allows you to compound that account and the earnings in the account and then take it out in a year that you might need it. Just save the receipts and you'll be able to take that account or that amount out at any time. This is really also beneficial because it's a long-term savings potential. One of the biggest reasons people drain their retirement accounts early is because of medical expenses. So by having this designated account and contributing to it each year, you can avoid one of those very common pitfalls. Another big benefit is, unlike a traditional IRA or traditional 401k, there are no required minimum distributions, RMDs. So you don't have to take that account out. And if you pass away, your spouse can inherit it, or your heirs can inherit it as well. You can also use the money in the HSA for Medicare premiums. So again, once you're 65, Medicare starts, you have to start paying premiums for those Medicare insurance. You can use that tax-free income to pay for those premiums. And lastly, really another benefit is being able to self-direct it. So you can put it into a stock market account if you want, but also you can buy real estate, you can buy gold, crypto, whatever it is that you're good at, you can invest in it, similar to IRAs. So today we covered the health savings account. Again, if you enjoyed this video, please like and subscribe. Comment if you have any questions. If you have any questions for tax planning, asset protection, or estate planning, go visit bristertaxlaw.com. Schedule a discovery call today. And thank you for listening.